are able to share the screen, let me start with thanking the organizers for inviting me to this wonderful event. The program of Armenian Economic Association's annual meetings is impressive, and I congratulate all the organizers for putting together this conference despite all the difficulties at this time. This talk is basically a joint effort of my macro staff and myself. I don't know whether the standard disclaimer applies here. Being new in a position, I didn't check with the lawyers, with the legal counsel yet, but the uncertainties are so everywhere, and then you'll see about uncertainties in my speech as well. The topic of my talk today is not surprisingly the COVID-19 and its economic implications. I'll first start with laying out the global context with particular emphasis on comparison with the global financial crisis of 2008 and 2009. I'll stress uncertainty, which at least in the short run will drive the economic activity, taking its toll on aggregate demand. After describing fiscal and monetary policy response around the world and zooming in on emerging markets, I'll present our economic outlook for Armenia. The overarching message is that despite the very aggressive fiscal and monetary policy response, macroeconomic policy cannot fundamentally address the health crisis, which is the key unknown in all our scenarios. The role of macro policy, though, is to preserve macroeconomic stability at these difficult times so that macroeconomic and financial aberrations do not derail the recovery. In this respect, I would like to stress that the Central Bank of Armenia has the necessary policy space to preserve the price and financial stability in Armenia. Sorry. I'm trying to change the slide, but it doesn't work somehow. Okay, now it works. Sorry for interruption. So this is the outline of my talk. Let me start with the magnitude of the shock. This slide shows the expected growth slowdown in advanced and emerging markets in 2020. Both advanced and emerging markets will face much bigger slam compared to the GFS. The left-hand slide graph shows that according to the latest World Economic Outlook update on June 24, which was like 2 days ago, advanced economies will contract by 8% in 2020, compared to 3.3% in 2009. Emerging markets will contract by 3% in contrast to positive 2.8% growth in 2009. The right-hand side chart in turn depicts the share of economies which will be in recession in 2020. Strikingly, almost all the countries will be in recession this year, surpassing the global financial crisis year by a wide margin and exceeding even the Great Depression. It is worth noting that these forecasts are likely to be revised quite a bit over the next 2 quarters as the fundamental uncertainty around the resolution of the health crisis is out of the sight as of now. Let us zoom in on emerging markets for the moment. Emerging markets faced unprecedented capital outflows both by speed and the magnitude after the COVID shock. Indeed, as the left-hand side chart illustrates, during the first 3 months after the outbreak, $100 billion left emerging markets. The right-hand side chart shows that this episode belittles the global financial crisis capital outflows, which stood at 35 billion only, if we could call it only. Of course, it is too soon to judge the developments for the Q2 as there is no data available. However, some preliminary estimates indicate that the capital outflows have somewhat reversed in April. I stress the uncertainty at the beginning of my talk because it contains a key judgment guiding our policy. Indeed, one of the main questions given the unique type of the shock is the relative slowdown of supply and demand. The answer to this question has direct implications for monetary policy. A sharper decrease of demand versus supply will have a deflationary implications in the short or medium run, whereas the opposite will be true in case of supply contraction if the supply contraction is more severe. Our judgment is that in the near term, the elevated uncertainty will lead to sharper decrease in demand compared to supply, leading to deflationary pressures. A good example is the US personal savings rate, which jumped to 33% in April, reflecting the precautionary savings in the face of uncertainty. Of course, this judgment is subject to continuous revisions given the possible effects of the pandemic on supply chains. Uncertainty in the current context has many facets. The left-hand side slide is stylized illustration of uncertainty around the recovery. Indeed, the much debated V-shape, L-shape, or other shapes of recovery are pretty much on the table right now. The worst case scenario is depicted by the yellow line on the left, which is the case when the growth slows down persistently. Possible stories behind this include hysteresis in labor markets and skill destruction, supply chain destructions, structural change in demand, etc. Arguably, one of the main roles of macroeconomic stabilization policies at this stage is to pull economies further from this dangerous edge to avoid long-term damage. To conclude at this point, the right-hand slide chart shows the distribution of growth forecasts now and at the outset of global financial crisis. Clearly, nowadays, the shape of recovery is much less clear as the distribution of forecasts is about twice wider. Just to do a little bit of marketing, we will have a detailed box on this in our next inflation report to be published on June 30th, which I invite you to read. Of course, the uncertainty around the real side of the economy is reflected in the financial markets as well. Clearly, the volatility in financial markets is similar to what we saw during the global financial crisis. You can observe both Dow Jones and CBOE VIX on your screens. Zooming in on emerging markets again, we can see that investor risk aversion jumped abruptly since March. The left-hand side chart shows a proxy for country risk premium for selected emerging markets, including Armenia. In some countries, the risk premium tripled in a matter of months. In case of Armenia, the risk premium shot up below 2 percentage points to above 6 percentage points. These premia, however, have mostly recovered, which is consistent with earlier observation that capital outflows have somehow eased during the last 2 months. We also witnessed some sharp devaluation of national currencies in terms of nominal exchange rate in emerging markets, which was reversed as well. Moving to policy, I would like to discuss fiscal policy in the face of COVID-19 shock first. My first observation is that countries entered the current recession with much higher levels of public debt compared to global financial crisis. As the left-hand side chart shows, this is true irrespective of level of income. Advanced economies, for example, had around 105% of public debt to GDP ratio in the beginning of 2020, as compared to 71% in 2008. Does this imply less fiscal space to act? We have to be careful here, as the levels of public debt are not straightforward to interpret. Indeed, this is a topic of fierce debate nowadays. On one hand, some economists claim that given the ultra-low interest rates, which are likely to stay with us for a long period, sustainable levels of public debt are much higher. Moreover, as long as G is greater than R, it makes sense to borrow cheap and invest in public capital with higher return. Even though G will be low this year, but in the medium run, it will most probably exceed R. On the other extreme, the argument is that public debt increase cannot go on forever, and markets at some point will impose fiscal discipline by pricing in non-linear increase in borrowing costs. On this question, jury is still out, and I expect it to stay as a topic for fierce debate for coming years. But one thing is clear: developed and developing countries face very different constraints. To illustrate this last point, let us look at the announced fiscal stimulus package around the world in response to the pandemic. The right-hand chart depicts the size of fiscal stimulus in terms of percent of GDP against the per capita income. The pattern is unmistakable. Poorer countries, even with lower levels of debt, announced much less counter-cyclical fiscal policy compared to their richer peers. Moreover, the pattern is non-linear. More generally, a more formal analysis, which I do not show here due to time constraint, clearly shows that the level of country risk derived from rating agency assessments explain much of the variation in fiscal stimulus. Of course, the caveat is that these are announced packages which may differ from actual implemented ones, but nevertheless. Let me turn now to monetary policy, concentrating on emerging markets. It is quite striking that there is a dramatic shift in monetary policy response since the global financial crisis. Indeed, as the slide shows, after the global financial crisis, at least in the short run, the majority of emerging markets had to tighten their policy. Whereas after COVID-19 shock, the picture is completely reversed. The majority of countries substantially eased their monetary policy. What is driving this shift? One of the possible explanations is that inflation is much lower and better anchored now in emerging markets, creating policy space to react. This is certainly true for Armenia. We were the first in the region to react when other countries were not able to ease in the face of capital outflows. Our assessment is that our disinflationary policy since 2014 shock created this policy space for us. Of course, any developments are possible since there is no clarity about the resolution of the health crisis. However, my main message is that we have room to adjust our policy on both sides as fiercely as needed. Without going into much details, I'd like to point out yet another interesting development. Many countries, including emerging markets, resorted to a variety of QEs much more forcefully and quickly compared to global financial crisis. Of course, advanced economies like US had experience in doing this, so to some extent, the sizes of their packages, even though unprecedented, were not surprising. What is new is that emerging markets, which have conventional monetary space, choose to implement QEs. That is very interesting. The most common explanation behind this is the nature of the shock, which involved major liquidity shock caused by the crisis. According to this story, the liquidity shock prompted emerging markets to intervene to stabilize the markets. Here again, the jury is still out and time will show. In some of these actions, if some of these actions were opportunistic. Having laid out the global context, we can now move to economic outlook for Armenia. The slowdown in economic activity most probably hit the bottom in April, following the strict lockdown. In May, the year-on-year decline of economic activity stood at 12.8% and was broad-based. Both import and export compressed, which is consistent with demand slowdown story. We will publish our next forecast next week, but I will show you here the timeline of our previous forecast revisions. The left-hand chart shows that our growth forecast for 2020 was revised down from above 6% growth in February to the negative territory. The two biggest forecast revisions took place in the middle of March, when the state of emergency was declared, and then strict lockdown followed. The right-hand chart shows that we see the recovery much protracted as compared to our last published forecast. This revision was one of the main reasons we decided to increase the policy rate by 50 basis points during our last interest rate setting meeting. Fiscal policy in 2020 will be more expansionary compared to the original budget with 5.5 fiscal impulse. The latest change of corporate tax administration will likely add another 0.9 percentage points. Notably, fiscal policy rightly used the escape clause in the fiscal rule to implement a counter-cyclical policy. The debt is expected to be around or slightly exceed 60% at the end of 2020. Given the nature of the shock, fiscal policy is the first line of defense with its broad base of instruments. Moreover, in contrast to monetary policy, the expansionary fiscal policy is well placed irrespective of relative strengths of demand and supply slowdown. The Central Bank of Armenia eased 3 times since March, decreasing the key rate cumulatively by 1 percentage point. This was accompanied by significant increase in our weekly refinancing operations. The weekly refinancing volumes quadrupled since March. The right-hand side chart shows that these monetary policy actions succeeded in stabilizing the government bond yield curve. It is worth stressing again that the ability to ease monetary policy when facing significant uncertainty and volatility in financial markets was a result of consistent policy after 2014 oil shock. The disinflationary policy that the Central Bank of Armenia followed since then clearly paid out. Nevertheless, it is too soon to judge on the results of monetary and fiscal policies, as the health crisis is not over. Let me conclude at this point and open up the floor, probably if we have time, for several questions, and conclude with some ideas, and some concluding remarks. First one is that despite the forceful monetary and fiscal response all over the world, there is still no clarity around the shape of recovery. The second point is that public debt will be a key question for years to come. And related to Armenia, we think that in Armenia, economic outlook critically depends on the health developments, which is a key uncertainty in all our forecast scenarios. To finish my talk, I would like to emphasize the importance of research and this kind of conferences for the Central Bank of Armenia. You will see today my colleagues presenting their models on COVID-19 and its policy implications, which was done literally in a matter of weeks and fed into our actual decision-making process. There is no better proof of importance of evidence and research-based policy making. With this, I would like to thank you all for your attention and wish you a wonderful conference.
Thank you very much, Martin. Thank you very much, Governor. And it's a pleasure to host you. I think we haven't had the questions written in the chat window. Correct me if I'm wrong, Zare. If we didn't, I'll extend the floor to the participants and ask if there are any questions about this. Can you hear me, Zare? So, okay. Well, in general, maybe a very small question for myself. I'm curious about perhaps public debt sustainability issues. Is there any, can you discuss or extend an argument about that? In general, what we would be expecting, what could be expected? What we did, we had a survey where we had quite inconclusive results in that respect. I'm just curious if you can talk about that a little bit, please.
You mean in a global context or in terms of Armenian economic development?
Well, both.
Yeah. So the story goes as following. So there is a huge debate about how much can be actually borrowed in terms of global context. We see that, for example, let me start with developing ones. So you see that developed countries, for example, they borrow as hell. So they borrow as much as they can without taking into account probably future developments. And that's where the debate starts. How much they can borrow with the cost at which they borrow now. Is there any possibility that at one point the markets will start punishing them with putting much more stress on their interest rates level? And that thing could be nonlinear, as I described. On the other hand of the argument are people who would tell you that as at the point where expected growth rate, I don't mean even the growth rate for this year, but people like Larry Summers who would tell you that at the point where your expected growth rate is larger than the interest rate that you are charged on the borrowing, then it does make all the sense to borrow and invest in public infrastructure, especially in the countries like United States where they lack that. And that's probably the heart of the debate. Here, they are in a better shape in this sense. They have a higher level of debt, but we see that the market believed in their promise at this point. I don't know what will happen later down the road, but I think that's the story on the developed side. In terms of developing countries, which Armenia included, I think we should be much more cautious in this way. Some people would disagree and they would tell you that if you borrow as much as you can, then the problem, you don't face the problem, investors face the problem, basically. Moral dilemma. But I think markets will punish emerging markets faster and sooner than the developed world. So yeah, I was listening to the discussion yesterday of Jacob Frankel and then Klaas Knot from the Dutch National Bank and then the governor of Federal Reserve Bank of Dallas, Bob Kaplan. All of them were alluding to the fact that for the emerging markets, you should be very careful when you're adding up to the stock of your debt that you previously have. That would be probably the main message.
Thank you very much. There are a few other questions from in the Zare. Can you please have a look at this as well? A few other questions that were actually added to our chat window. So. So there is a question, what are the expectations on the development in the foreign exchange market in Armenia, given the negative outlook of tourism, export, and capital outflows?
I think if you look at it as a pure balance of payment exercise, with all the uncertainties that we have, I wouldn't take a confirmed kind of stance on that. But it seems like there will be a decrease in export as well as in import. So it depends on the magnitude of the inflow and outflow of the currency. And probably, as you all know, we have a free-floating exchange rate and probably will let the market decide on what the exchange rate would look like. That would be decided by demand and supply in the foreign exchange market. That would be the short answer to that.
Thank you. Yet another one, if I may. there is another question. Where does Armenia plan to raise additional funds after the IMF? If it does plan to do so, what type of bonds do we plan to issue? Armenian dram denominated, well, the US dollar denominated, short or long term?
I think the question is in the domain of our colleagues from the Ministry of Finance. I wouldn't even dare to enter their zone. But if I'm taking my hat off an economist, not the central bank governor at this stage, I think there are many ways that they can take extra money from. One would be the Eurobond market, and I mean Eurobond market denominated in Armenian drams. That is one of the possibilities. The other possibility would be also to go to international financial institutions and ask for extra. But at this point, we don't have any problems with attracting new debt, I think. That's not the critical thing for the Armenian economy. More critical is how do we spend that money which arrived already.
Thank you very much. We seem to have a small other question as well. What are the trends in savings for Armenia during the pandemic? Even though it might be that we don't exactly have a lot of data on that. If you want to reflect, please. Otherwise,
we don't have data yet on the labor market side, but we expect unemployment to increase, and that would mean that the saving rates will fall a bit. But we don't have the data yet to be certain about our judgments.
Thank you very much. With this, oh, there is yet another message. Sorry, if I may, the questions are flowing in. You said that the exchange rate floats freely. Are you worried about the magnitude of US debt of the public and private sector?
You mean, am I worried about the US debt personally, or in terms of their implications and applications on Armenian economy? I think we're not there yet to fully understand what this new level of debt rising will look like. It will take time, and as I mentioned in my speech, it will take time to understand what comes with that. We see basically that there is a high unemployment in US. We see increase in their savings rate. We don't see whether the savings will flow into investments or other types of things. So there is much to look around. So I won't be certain at this point telling what would happen to US after increasing their debt level.
I do apologize. Oh, sorry. Please go ahead. I do apologize. I misinterpreted the question. I didn't read it very well. So the question was about US dollar denominated debt back in Armenia. Whether keeping a free exchange rate could cause some worries because of US denominated debt.
I think the way that the government described it, I think in their last year's program, we fully support their effort in reducing the dollar-denominated part of the debt, and attracting more debt in national currency does make a lot of sense. We understand that clearly crisis after crisis, and I think they were on the right path to do that. I don't know how the picture will change with the COVID because of all uncertainties. Certainly there is this part of the risk that part of our debt is denominated in dollars. But at this point, I think that we are macroeconomically stable and there is no need to be worried at this point.
Thank you very much. With this, I would like to conclude. Thank you very much, dear Governor. It was a pleasure to host you. It was a very informative talk about Armenian economy as well as global trends. It is a pleasure in general to host you and learn these trends back in Armenia. Thank you.
Thank you for having me, and have a wonderful conference, as I said. Thanks.
Thank you.
Bye.